Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilburn, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you doing?
Doing great. Well, it's interesting, Scott. We've seen the trade tariffs conversation kind of on pause for the moment in the wake of the G20 meeting this weekend. What are your thoughts? It seems like there's more uncertainty after that meeting.
There is, and you said, really that we're on pause for the moment, and that really holds true. There's way too much risk headline out there for this to be over yet.
And it will be interesting to see. The markets are closed tomorrow, but as we kind of consider risk mitigation tools, are you ready to get in this first lightning round?
Absolutely, let's do it.
Santa Claus rally. Well, we did see the Rocktober. Then we saw kind of a nasty November. But now in the month of December, it's a little bit of a tug of war. So what are your thoughts as we've seen a recent movement in the S&P 500? Last week was the best week we saw in the E-mini S&P 500 in nearly 7 years.
Exactly. Jeff, I'm really looking to capture the recent increase that you just talked about for the E-mini S&P 500.
Well, typically, we like to approach this with either a call spread, a put spread. But this week, do you want to have a different way to express your view?
I do, and I'm looking to do a combination of that, something that's called a risk reversal. And what I'm looking to do is sell a week 4, which is the December 28th expiration, E-mini S&P 500 week 4. I'm going to sell the 28.25 call, and I'm going to buy the 2700 put. So I can do that for close to even, maybe pay a little bit. We typically like to get a credit out of these, but this is some really good risk mitigation that doesn't cost much at all.
Well, and utilizing risk reversal makes a lot of sense. So if you have a long equity exposure and you're trying to go into the month of December and maybe you are a little bit leery of that Santa Claus rally, by selling that upside call, you will limit the upside. However, you typically have a little bit of a collection there, but that downside put, owning that downside put helps a lot of people typically sleep a little bit better. Is that right?
Absolutely, and it's kind of stopping me out a little bit. I can sleep a little bit better at night. And the pricing on this is with the December future trading about 27.75 and a quarter, and the at the money volatility about 14.4.
Fantastic, Scott. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
All right, let's do it.
Fed rate hike. Well, it certainly is seemingly a slam dunk for the Federal Reserve in about 2 weeks' time to raise rates again. The CME Fed Watch tool certainly has a high probability. What are your thoughts on an additional rate hike here?
Yeah, no doubt about the one coming up here. And then, the question is all about the Fed speak and what's going to happen going into 2019.
Well, it's interesting, Scott. We watched that 2-year, 10-year spread often here. We talked a lot about striking options. Right now we saw it narrow down to 13 basis points. And honestly, I actually thought the 10-year note at 3.04% was going to stay range bound. That was 10 basis points ago. So right now the trade example I want to utilize, Scott, is to help in a situation where he continues to see that 10-year yield go lower and that 2-year yield go higher. So I'm buying a call spread in the 10-year note, buying essentially at the money, that December 120 call. It's a week 2 call, and I'm selling the same expiration in week 2, 121 call. That call spread I'm buying costs about 11 ticks, or in layman's terms, about $171. And this trade expires a week from Friday on December 14th. What are your thoughts as we saw the December contract and the underlying trading about 119.25 half when we priced out this trade example?
You know what, it seems like a great opportunity if there's a continuation with the way rates are going now, and it's a pretty quick move. Like you said, it's expiring next Friday.
Well, what's interesting, if we don't see this move continue to go down, we're defining what we're paying for this. And I think that's really critical, and that's why we utilize options on futures. We're going to admit the fact that maybe we didn't see this move in the 10-year happen, but we're going to put $171 in this trade example out there to help us mitigate risk to the downside in the event we see that 10-year yield continue to go lower and prices go higher.
Yeah, I think the key that you just said there, Jeff, is that your risk is defined.
That's right, Scott. Well, thanks as always for coming on to Striking Options. And please tune in every week as we will continue to strike options.